Good morning, everyone, and welcome. Now, I want you to take a look around this room. You are the future of this firm. My goal today, it isn't just to teach you a set of tools. It's to help you forge a very specific mindset. You see, to succeed in today's market, you have to become what I call a warrior poet, someone who is fluent in both the art of business valuation and the cold, hard science of data and probability. This is your challenge, and today is where it all begins.
Let's start with this piece of wisdom from Warren Buffett. It's our foundation. Now, you might think this only applies to the classic value investor, the one patiently waiting for a stock's price to meet its intrinsic value. But it applies just as much to us, to the quantitative analyst who patiently trusts their models, even when the market is full of noise. Patience, when it's backed by a robust, repeatable process, is a universal advantage.
So here's our roadmap for today. We're going to start with the big one, alpha. Then we'll build out the framework for how to actually construct a strategy. After that, we'll look inside the toolbox at some different models, we'll use China as a really powerful case study, and then finally, we'll bring it all together into what really matters, real-world practice. Okay, so section 1, alpha, the search for excess returns. Let's get right to it. What is this elusive thing that we are all chasing?
Now, your textbooks will tell you that alpha is just outperformance. For us, as practitioners, it's got to be so much more tangible than that. It is a real, verifiable edge. It's some kind of inefficiency or a pattern in the market that isn't just random luck. And it has to tick 3 boxes. It's got to be persistent over time, you have to be able to prove it with data, and, this is the most important part, it has to be structured in a way that we can actually build a strategy to capture it. Our entire job is to find that signal buried in the constant noise of the market.
So, how do we hunt for that signal? Well, there are really 2 fundamental ways to go about it. The theory-driven approach, that starts with a hypothesis. You have an economic intuition, something like cheap stocks tend to outperform expensive ones, and then you use data to see if you're right. The data-driven approach, though, it flips that on its head. It starts with a massive, and I mean massive data set, and uses incredible computing power to find hidden patterns, stuff we might never have even thought to look for. So one is about validating a belief, the other is about seeking a revelation.
Which brings us to section 2, the alpha model framework. Now that we know what we're looking for, this is the blueprint for how we systematically go about building it.
This is where it gets really practical. Every single quant strategy that has ever existed is defined by the choices made right here, at these 6 steps. Think about it. Are we predicting the direction a stock will move, or the magnitude of that move? Is our holding period a few minutes, or is it months? Is this a simple long-only bet, or a complex market-neutral pair trade? And which stocks are we even looking at in the first place? These choices, they are the operational DNA of your alpha engine.
All right, section 3, paradigms and dynamic evolution. It's time to open up the toolbox. But you have to remember, in our world, the tools themselves and the market we use them in, they are constantly changing.
Let's start with one of the most powerful forces in all of quantitative finance, mean reversion. It's a simple but profound belief that things get stretched too far. Prices, spreads between 2 stocks, valuations, they get pulled away from their long-term normal, and eventually they have to snap back. This single concept is the absolute bedrock of countless successful strategies.
But, and this is a big but, to properly use mean reversion in something like pairs trading, you have to understand this critical distinction. Correlation is just 2 stocks moving together for a bit. It can be temporary, it can even be a total coincidence. Co-integration, though, that is much deeper. It means 2 stocks share a real long-term economic equilibrium. Even if they wander apart for a while, they are fundamentally tethered together. So a robust pairs trade, a real one, is built on the statistical rock of co-integration, not the shifting sands of simple correlation.
And that brings us to the harsh reality of this business, alpha decay. No edge lasts forever. It's just a fact. Once a profitable pattern is discovered, capital floods in. That inefficiency gets arbitraged away, and poof, the alpha's gone. This creates a relentless, perpetual arms race. The only way you survive, the only way, is to innovate faster than the market can adapt.
On to section 4, China's unique ecosystem. This is the perfect case study to prove, beyond a shadow of a doubt, that quantitative models are not universal. You absolutely cannot just copy-paste a strategy that works in New York, drop it into Shanghai, and expect it to work. It just doesn't.
Just look at this chart. This right here is the single most important structural feature of China's A-share market. With over 80% of trading volume driven by retail investors, the market is fundamentally dominated by behavioral biases. You know, herding, chasing momentum, overreacting to news. For a quantitative strategist, these predictable, non-rational behaviors create a target-rich environment. It is fertile ground for capturing alpha. And this table is the direct result of that market structure. Factors behave completely differently. In China, value and especially reversal, which is just betting against recent trends, are incredibly strong. And why is that? Because they are systematically betting against those very retail biases we just talked about. Meanwhile, momentum, a classic powerful factor in the US, is weak. This proves unequivocally that your alpha models have to be localized. They must be custom-built for the specific market you're trying to beat.
So who's actually winning this game in China? Well, if you look at the leaders, you'll see there isn't just one path to success. There are a few distinct philosophies. First up, you've got the technologists, like Highflyer. They're betting on sheer brute force, massive supercomputing power and AI to capture fleeting, high-frequency signals in the market.
Then you have the evolutionists, like Ming Xi. They really represent the journey of mastering the craft. They progressed from simpler, linear models in the early days to now embracing the full complexity of machine learning to find that signal in an increasingly noisy world.
You also have the defenders, like Lingjun. Their core weapon isn't some single magic signal. It's incredibly robust risk management. They do this through diversification, combining many different strategies and factors to build a portfolio that's resilient no matter what the market throws at it.
And finally, you have the trailblazers, like Jukan. Their edge comes from unique alternative data sources that other people just don't see. We're talking satellite imagery, supply chain data, anything to gain an informational advantage. So you see, technology, evolution, defense, or information. These are the pillars of modern quant success. You have to decide which one you're going to build upon.
And now we bring it all together. Section 5, from theory to practice. This is your mandate. These are the disciplines you absolutely must master if you want to survive out there.
You have to understand overfitting. I call it the original sin of our field. This is what happens when you torture the data until it confesses to anything you want. Your model looks absolutely perfect in a backtest because it has essentially memorized the random noise of the past, not the true underlying signal, and the result is always the same: a spectacular backtest followed by disastrous real-world losses.
So our defense against this is pure scientific rigor. We build guardrails. We always test our models on out-of-sample data that the model has never seen before. We use techniques like cross-validation to make sure our results are robust and not just some statistical fluke. And we use regularization to actually penalize complexity, which forces our models towards simpler, more elegant, and usually more robust solutions. This stuff is completely non-negotiable.
So this is your mission. This is your roadmap. Start by mastering the art. You need to learn how to analyze a business like its founder would. But you cannot stop there. You must also embrace the science. Learn Python, learn statistics, become a master of data analysis. Your ultimate goal, for every one of you, is to achieve a synthesis of the two, to become what we call a quantamental investor, someone who combines deep, fundamental insight with systematic, data-driven rigor.
Your journey really does start today. And it's not about choosing whether you want to be the next Warren Buffett or the next Jim Simons. It's about learning from both of them to build your own unique, robust, and repeatable investment process. The market is always going to be asking questions. Your process is what has to provide the answers. Now, let's get to work.